All right, here we go. This is going to be a practice problem for chapter 9. And I'm pulling these from the comprehensive problems at the end of the chapter. If you're interested in buying a sponsorship to be a sponsor of one of these videos, please send me an email. Okay, so here we have Joe. Joe operates a business that locates and purchases specialized assets for clients, among other activities. He uses the accrual method of accounting, but he doesn't keep any significant inventories of the specialized assets that he sells. Joe reported the following financial information for his business activities during year zero. All right, the book likes to use this terminology where they say year zero to mean the current tax year. All right, so we're just going to go one by one through these items and figure out what's the effect on his business, right? What is a gross income? What's a deduction? Joe signed a contract to sell gadgets to the city. The contract provides that sales of gadgets are dependent upon a test sample of gadgets operating successfully. In December, Joe delivers $12,000 worth of gadgets to the city that will be tested in March. He purchased the gadgets especially for his contract and paid $8,500. So here, all right, we can think about income. All right, so accrual method income, our first requirement, right, under the all events test is that the right to receive the income has to be, right, all the events have occurred to establish the right to receive the income. All right, well, this income is contingent on the city testing it, excuse me, next year, right, and the items passing the test, right? So because this income is contingent, right, all the events haven't occurred to establish his right to receive it. So, right, he currently recognizes $0 of income for year zero. All right, as far as his purchase of the gadgets, because this is, excuse me, sorry, because this is, he's on the accrual method, right, he's going to match the cost of the goods with the revenue when he recognizes it. All right, so he's also going to have deductions 0. Next, Joe paid $180 for entertaining a visiting out-of-town client. They didn't discuss business, but Joe wants to maintain good relations to encourage additional business next year. All right, so the key here is that they say entertaining. All right, entertainment is not deductible. All right, if they had gone to a meal, all right, then he could deduct $90. But entertainment is not deductible. Okay, next, on November 1st, Joe paid $600 for premiums, providing for $40,000 of key man insurance on the life of Joe's accountant over the next 12 months. That's right, the accountant's a key man. Okay, so this is one of those exceptions where, because if the policy pays out, the benefits will be tax-free, they'll be excludable to Joe, and so the premiums can't be deducted. So this is going to be another deduction, $0. At the end of the year zero, Joe's business reports $9,000 of accounts receivable. Based upon past experience, he believes 2,000 of his new receivables will be uncollectible. Right, because he's on the accrual method, right, he has to recognize income as soon as it's earned. Right, so he's got $9,000 even though he hasn't collected it yet. As far as deductions, for tax, you have to use the direct write-off method, even if you're an accrual method taxpayer. So he can't write off those receivables until he actually writes off a specific account. All right, in December of the current year, Joe rented equipment to complete a large job. Joe paid $3,000 in December because the rental agency required a minimum rental of 3 months. Joe completed the job before the year end, but he returned the equipment at the end of the lease. All right, with rent, right, we're on the accrual method. All right, there's no income here that we know of. All right, so we're thinking about the deduction. When can he deduct the cost of rent? Right, prepaid rent. Right, so prepaid rent under the accrual method, under the cash method, he might be able to deduct it, but as an accrual method taxpayer, he can only deduct the 1 month that occurred in the current year. The other $2,000 he'll deduct next year. Right, it would be the same if he had prepaid interest. All right, Joe hired a new sales representative as an employee and sent her to Dallas for a week to contact prospective out-of-state clients. Joe ended up reimbursing his employee $300 for airfare, $350 for lodging, and $250 for meals. All right, he provided adequate documentation to substantiate the business purpose for the meals. He requires all employees to account, right? So there, he is satisfied the requirements, so his employee is going to be able to get reimbursed, right? And that won't be income to her. All right, so what can Joe deduct as a business owner for these travel costs of his employee? All right, so since the purpose was primarily business, it's primarily a business trip, then all of the airfare is deductible. Right, the transportation cost. The lodging, right, since we're assuming all the days were business days, the lodging is deductible. And the meals are going to be, right, 50% deductible, right? 1/2 times 250. Okay, so as the owner of the business, Joe can deduct that as an ordinary and necessary expense. Joe uses his personal automobile, a BMW, to travel to and from his residence to his factory. However, he switches to a business vehicle if he needs to travel after he reaches the factory. Last month, the business vehicle broke down. He was forced to use the BMW both to travel to and from the factory and to visit work sites. He drove 120 miles visiting work sites and 46 miles driving to and from the factory from his home. He uses the standard mileage rate to determine his auto-related business expenses. All right, so it's pretty simple, hopefully. The 46 miles driving to and from the factory from his home, that's commuting, not deductible. However, for the 120 miles driving from his main workplace to visit work sites, he can deduct the standard mileage rate of 58 cents per mile. Should get $69.60. Yes. Lastly, Joe paid a visit to his parents in Dallas over the Christmas holidays. While he was in the city, Joe spent $50 to attend a half-day business symposium. Joe paid $200 for airfare, $50 for meals during the symposium, and $20 on cab fare to the symposium. All right, so this one, right, it's implied, all right, if he's visiting over the holidays, right, he's there, right, for multiple days. The primary purpose of the trip is personal. All right, so let's see. All right, on airfare for domestic travel, we go all or nothing. Since its primarily purpose is personal, he can't deduct any of the airfare. All right, the cost of the symposium itself, right, like a registration fee, is deductible. The meals during the symposium, right, are going to be 50% deductible. And the cab fare to get right to the symposium will be deductible also, right? Because that's purely business transportation. All right, so he'll have a total deduction of $95. All right, so that's that problem. And hope, right, nice, because it hits a lot of different little topics for us. And I'll do at least one more from chapter 9.